The American Phoenix says don't hold your breath for a sound recovery in 2012. Its authors say the seeds of another global economic disaster are already sown thanks to a failure to agree on integrated solutions to previous crises. And beyond 2012, the picture, well, that's grim as well. The book says Germany may stagnate at best, leaving much of Europe at risk of depression. China will see the end of its miraculous growth, bring about economic turbulence and the need for some painful reform. Meanwhile, the US will rise from the ashes to regain global financial and economic dominance. Well, I'm pleased to say that Charles Dumas is a co-author of The American Phoenix, as well as chairman and chief economist at Lombard Street Research. His book is informed by his 40 years of experience in and around financial markets. Joins me in the studio now. Charles, good to see you. Well, so I suppose in the short term, you're not so bullish about the prospects for the States, but nevertheless, you're saying they're very well positioned for a long-term recovery. Why is that?
Well, I mean, first of all, in the short term, Phoenixes rise from the ashes, so the short term is the ashes, which is next year, basically. And that's because everyone is deflating like crazy. The scope for monetary policy on any kind of scale will only emerge as and when a recession has actually happened or is upon us. There's very little escape from the rest of the world to offset the developed countries' deflation because China's deflating too. China has a serious inflation problem arising from its stubborn insistence upon not floating and not opening up its financial markets, not opening up its exchanges. The result is that because they're undervalued, they have tremendous inflation, and it's that inflation in China which has finally got the United States into good relative cost position. And that's the key to the future.
Why is that? Why is the US going to benefit from inflation rates in China?
Well, because until over the last 18 months, Chinese unit labor costs, labor expense per unit of output, has been going up by 10 percentage points more per annum than the United States. Americans flat as a pancake. In China, it's going up more than 10%. They've got a real inflation problem. The result is that, on top of that, of course, the yuan itself is going up. And so the result is that suddenly the United States has achieved the competitiveness it needed to achieve.
But this is going to be, I mean, when are they going to feel benefits from that? That's not going to happen next year, is it?
No, because in the first instance, the Americans are having to tighten their belts and get rid of their budget or reduce their budget deficit, which invariably, because everyone else is doing the same thing, means that the whole world economy is going to go down. I mean, the IMF hinted at it yesterday, but the truth is the mainstream forecast is now.
I mean, if you look at the fundamentals in the US right now, though, you have very high unemployment, you have, the consumer spending isn't what it should be, a weak run of economic data, and there seems to be very little. There are many economists out there that say the policy cupboard is essentially bare. There's very little they can do. So I mean, it's very difficult to think that a recovery, or at least long-term prospects, are going to improve anytime soon. What is going to be the catalyst? Is it just all down to China?
No, no, no. The Chinese are the people who, through their inflation, have made the Americans competitive. The result is that the American growth in future is going to come partly, of course, from some improvement of demand, because once we have this crash next year, the oil price will go down and a whole lot of other things will get more favorable in terms of people's costs. But then coming out of that, as well as a slight improvement of demand, you're going to have increased American share in world output, particularly American output. So it's import substitution. They'll get a bigger share of the total demand, and the imports will get a smaller share.
Now, you also talk about Germany, and you say that stagnation for Germany is a best-case scenario for you. Why is that?
Well, because the Germans refuse to consume. They entirely depend on exports. Their big white hope is the Chinese market. The Chinese market's going to be much slower, so Germany will have a disappointing time. If you look at Chinese investment, it's 49% of GDP. In 5 years' time, it'll probably be down to 40% of GDP, which means that even with a reasonable amount of growth, there's going to be no improvement at all in Chinese imports of capital goods, which is Germany's great strength.
Consumer spending has been improving in Germany, though, through the course of this year, hasn't it?
Consumer spending went down in the latest quarter.
In the latest quarter, but the trend has been upwards, hasn't it?
I don't know what you call the trend. The consumer spending in Germany is 3% up over 10 years. That's 0.3% per annum. It is pathetic.
So if growth is slowing in China, what does that mean for the developed world?
Well, what it means for the developed world is that you better not depend on export-led growth to get going. You better have a dynamic domestic environment and a competitive package.
Thanks very much indeed. Charles Dumas, Chairman and Chief Economist at Lombard Street Research.